Good evening, students. I see Ankit Sharma. Welcome you in our income tax session, in which we will be discussing today the provisions of capital gain. This is our session 2 for this head, that is income under the head capital gain. So, Namaskar, good evening, and Jai Hind, of course. So, I believe that you must have gone through with the provision, what we have discussed in our first lecture of capital gain. Today, we will discuss further provision like cost of acquisition in case of shares, other asset. Then there are some exempted capital gain. Those are the cases in which transfer would not be regarded as transfer in section 47 and the practical applicability or implication of those provisions. So, and also there are homework also, some question also we are going to discuss. There will be, of course, the thought for the day and of course, a short story at the end of the class. So, good evening, Soumya. Good evening, Somesh. Good evening, Miss Almas. Astha is asking, sir, after 23rd July is written security listed in recognized stock exchange, but are not written other than unit like in older provision. Is there any difference? No. That's the same provision. There is no difference. Okay. Miss Priyanshi saying, good evening, sir. Kindly give me chance to take revision today. It will take 20 to 25 minutes. I have practiced at home. Okay, that much time we cannot give Priyanshi because we have a limited time of 2.5 hours for every session. If you will consume 20 to 25 minutes, that would be really difficult for me to complete the other topic also. So I can give maximum 7 to 10 minutes. You need to cut short your provision because we do not want to discuss those provision in detail. It should be just like a recap that what we have discussed in our earlier class, that what was the basic chargeability of capital gain section, the basic of capital asset, those are not included as capital asset. Then the transfer definition in very short. Then we have discussed the cost of acquisition and indexation concept. So if you are asking me to give you 20 to 25 minutes, that would be a really huge time. So if it is possible for you to take all these recap in 7 or 8 minutes, that would be sufficient. Else, I will ask everyone or 2 or 3 students to recap as per the provision wise. Like I can ask someone to let me know the recap of provisions of basic like charging section, capital asset and transfer. So somebody will explain capital gain charging provision and the definition of capital asset recap and transfer. Then someone else can tell us about the provision of indexation concept in short. And then the third can tell us about the provision of cost of acquisition, what we have discussed in session 1. Astha City, sir, in zero coupon bonds, only maturity or redemption is only transfer, or we can transfer in between also. If you normal sale it, that would be always regarded as transfer. Even that is an additional, that maturity and redemption will constitute as transfer. But if you are taking money and transfer any asset, that would be normal sale and it is always regarded as transfer in all cases. Okay. So Priyanshi is going to explain to us the recap of capital gain topic, as I've asked you that somebody should recap the provision. So Priyanshi, you can start, but please let me tell you, it should not be more than 7 or 8 minutes. Okay, that would be enough for us. So can we unmute Priyanshi?
Yes, sir. Good evening, sir. Sir, is there any background noise?
Okay. Little bit, but it's not that much.
Oh, okay, sir. So should I start?
Yes, go ahead.
Okay, sir. So we have learned about capital gains, what it actually is, the profits arising from capital assets, transfer of capital assets, that the profit arising from transfer of capital asset is capital gain. Now we have seen what is capital assets and what is transfer. So capital asset includes that it should be a transfer, property held by SSC, securities held by foreign institutional investors according to SEBI regulations, and ULIPs, unit linked insurance policy. But it excludes certain things, that is stock in trade, which comes under PGBP, Then second is personal effect, which is movable plus personal use. For example, a car I'm using, that is for my personal use and that is movable. So that will not be considered in taxable amount. But there are some exceptions further for this, which considered as capital assets, which are jewelry, archaeological collections, drawings, paintings, sculptures, any other work of art, say antique items. These items prices are always increasing, so these considered under capital assets. Then third exclusion from capital asset is rural agricultural land. Fourth, fifth, and sixth, these consist of bonds, specified bonds, say specified gold bonds, specified bearer bonds, and gold deposit bonds. Other than these bonds are considered under capital assets, which are shares, debentures, other bonds. Then we have seen what is capital gain and capital loss. That is if sale is more than purchases, then it is capital gain. If sale is less than purchases, it will be capital loss. Then we have seen what is transfer. Transfer under subsection 47 of section 2. It includes sale, exchange, relinquishment. Sale consists of monetary consideration. Exchange consists of non-monetary consideration, and relinquishment. It means it has two meanings. First meaning excludes from transfer, and second meaning includes in transfer. The exclusion which is under transfer is to waive, donate, gift, or leave rights voluntarily. That is exception of transfer. But inclusion of transfer is destruction, stolen or lost items. If it is insured by insurance company, then the sales consideration which we get as compensation, that will be sales consideration. But if it is uninsured, the full cost which has lost, that will be set off in capital gains. Second is extinguishment of rights, which means legally the rights has been taken over. Say I have taken loan from bank and I have mortgaged my property of 10 lakh rupees. So if I am unable to pay the repay the loan, then the bank can take the ownership of that building, and bank can resell it. So it is legally taken by the bank. Then the third is compulsory acquisition, which we will see in section 45. Fourth is owner converted capital assets in stock in trade. That is we will see. And maturity or redemption of zero coupon bonds, that also we will see. And sixth and seven points are taken together, that is talking about deemed ownership, which consists of part performance of contract and types of transaction. Part performance of contract means possession is given as consideration. For example, I am selling a building to Mr. A. I have not given him property, but Mr. A has given me consideration as a whole. So I'll give him keys for that property. So that key is the consideration, and the part performance of contract is done, just the legal work is left out. Then we've seen the capital assets. What are the short-term capital assets and what are the long-term capital assets? So this we have seen in two means. We have seen this before 23rd of July 2024 and after 23rd of July 2024, because on 23rd of July 2024 an amendment has taken place for capital gain chapter. So the securities listed in recognized stock exchange units of UTI zero coupon bonds, if its holding period is less than or equals to 12 months, it will be short term. But if it is more than 12 months, it will be long term capital gain immediately preceding date of its transfer. Everything relates to this point, immediately preceding date of its transfer. Second category is unlisted shares and land and building both. If its holding period is less than or equals to 24 months or more, then it will be short term. If it is more than 24 months, it will be long term. And the unlisted securities shares are not included. Unlisted shares are taken in second category, which is less than 24 months. Third category is unlisted securities excluding shares and other capital assets. If these holding period is less than 36 months or equals to 36 months, it will be short term capital gain. If it is more than 36 months holding period, it will be long term capital gains. But after 23rd of July 2024, it has been amended that category A will be same. Securities listed in recognized stock exchange units of UTI zero coupon bonds. If its holding period is less than or equals to 12 months, it will be short term capital gains. If it is more than 12 months, it will be more long term capital gains. But the category B and C has been combined, that unlisted securities including shares now and other capital assets including land and building both. If its holding period is less than 24 months, or equals, it will be short term capital gain, and if it is more than 24 months, it will be long term capital gains. But the category B and C has been combined, that unlisted securities including shares now and other capital assets including land and building both. If its holding period is less than 24 months or equals, it will be short term capital gain, and if it is more than 24 months, it will be long-term capital gains. There is no concept of 36 months or something like that. There is only 2 years of condition. But the note is under section 50AA, the units of specified mutual funds acquired on or after 1st of April 2023 or market linked debentures or unlisted bond debentures transferred or redeemed or matures on or after 23rd of July 2024, it will always be considered a short term capital gain irrespective of holding period. Always under section 50AA. Then we have seen the format. Then we have seen what is indexation, why it is needed. Indexation is actually needed due to inflation rate. Say if I purchased something in 2010 and I'm selling it in 2025 after 15 years, so due to inflation the amount is not same, obviously. So we have to see the present value of that 2010's amount which I have purchased at that time. So I have to see the present value.
Priyanshi, time up. Okay, you have explained very beautifully. Really, really good to see that somebody is doing that much sincerely revision of that topic. But we have limited time. You are actually explained to everyone that what was short-term capital asset, long-term, and you were also explained the concept, the charging section, the capital asset definition, etc. But from indexation, let we discuss again because we have limited time, so we have to carry further. So the
Yes, sir.
indexation concept we have discussed in the last class, and I believe that you all must have gone through with that topic, and it is just to match the currency what we have spent at the time of purchase of that property. That the index value should change that currency value into the present value of transfer year. So that would beneficial for your purpose, for the purpose of assessing. Then we have was discussing the provision of cost of acquisition. We will continue it from today. Well done, Priyanshi. Congratulations. You have explained very beautifully. Okay. So Asta
Thank
is
you, sir.
asking, so in page number 3.365, it is written that the income arising from transfer of such security by FPI would be in the nature of capital gain, irrespective of the presence or otherwise in India of the fund manager managing investment of the assessee. Sir, here what is mean by the presence or otherwise in India. So the person who is transferring that property does not matter where he is. So if the asset belongs to India, if asset is located into India, then if that is transfer, it would be chargeable under the head capital gain. Okay. Certain cost of acquisition, HUF also to be resident if transfer on or after 23rd of July. Yes, Astha, it should be correct. So if there is any deduction 24B, then this deduction will not be deducted. 24B is for income from house property. Why we are discussing section 24 over here? Okay, I have also given one thing to all of you regarding the definition of transfer under section 247. So I have asked that this 7th point must you have gone through in income from house property. The 6th we have discussed, and the 7th point also connected with the income from house property topic. So I asked you in the last class that you should tell me what exactly the meaning of this 7th point. And it says any transaction by way of becoming a member, acquiring shares in a company, society, etc., which has the effect of enjoyment of any immovable property. So who will explain me this? Who will explain this 7th point, which you should have gone through in income from house property topic? Who want to explain me this? What exactly this point says? That any transaction by way of becoming a member, acquiring share in a company or a society, etc., which has the effect of enjoyment of any immovable property. We have the example also. I believe that you must have downloaded the notes, what I have already uploaded, and you must have gone through with the example and you must have understood what exactly this point says. So who will tell what is the exact meaning of this point number 7? Why it has been included in the definition of transfer? What is the reason behind it? So, sir, is there any problem in net connection? सही चल रहा है? Okay, students were not responding, so I was thinking. So, chalo, I will explain what is the meaning of that point. And the point says, it is just like the point number 6. The point number 6 was saying that even if the case of part performance, if it is a part performance, still it would be regarded as transfer. In the same way, point number 7 also consider a case in which if you are an assessee and you take the membership of any company or a society, and against that membership, you have been allotted an immobile property to reside. They are not transferring it to you. Suppose you are Mr. A. Let me explain you. Suppose there is Mr. A and it is a society. Now, Mr. A took the membership of this society for 50 lakh rupees. Mr. A paid membership fees for taking this society membership, and the membership fees was 50 lakh rupees, which has been paid by Mr. A to the society. And the society is having a policy that who will become a member, they will provide them a house to reside. Technically, they are not transferring it. They are just providing the possession till the membership continue. If the membership dissolves, if the membership ends, we will return the money and he will return our property. But what is going to happen technically? It is practically a transfer. But to just save the stamp duty and the capital gain tax, Mr. A wants to save the stamp duty because he's the buyer. And society wants to save the capital gain because it's a seller. So just to save these two taxes, they have decided to make an agreement that we will provide a house against the membership fees. And the house value is also 50 lakh rupees. So the membership and the house value would be almost equal. So practically it is a transfer, but to avoid this thing, to avoid these taxes, they have made this kind of arrangement. So the definition of section 247 includes this type of arrangement also. That if there is a society or a company who provide an accommodation, a property to the members against the membership fees. So in that case, we will assume that as a transfer. And due to this, society needs to pay capital gain tax and Mr. A would be considered as deemed owner also under section 27 of income from house property. So that's why this section also covered, this provision also covered under section 27. So now Mr. A needs to pay stamp duty also. We will consider him as an income from house property deemed owner. But from the capital gain point of view, we need to tax the cooperative society, assuming that it's a capital gain transaction and it has been included under the definition of transfer. I hope it's clear. Moving on further, we were discussing the provision of cost of acquisition. So in cost of acquisition cases, we have gone through with the provision, and in those provision, we have discussed the cost of acquisition in case of intangible asset, that was goodwill of business, copyright, trademark, etc. And in all these cases, we have understood how to calculate the cost of acquisition. And the cost of acquisition discussed regarding goodwill of business, copyright and patent. If it is self-generated, it is nil always. If it is purchased, then it would be purchase price. If it is a goodwill of profession, that personal nature, not applicable, no capital gain. If it is self-generated commercial nature, the cost would be nil. If purchased, purchase price. The important thing, it does not matter whether in these two cases, these have been purchased before 1/4/2001 or on or after 1/4/2001, the provision will remain same. Then we moved on to the shares provision. In case of shares, we have discussed that if it is an ordinary shares, in case of ordinary shares, what will happen? If it is purchased and if it is purchased before 1st April 2001, then the cost would be FMV on 1401 or purchase price, whichever is higher. And if it is purchased on or after 1401, the cost of acquisition would be the purchase price. So till this point, we have discussed our provision in the last class. Now we need to discuss the bonus provision. The shares, if it is bonus shares, what would be the cost of acquisition? If it is right share, what would be the cost of acquisition? In case of bonus shares, again, this date is very important. 1st April 2001 is a very important date. Why I am repeating business and profession? Then it does not affect the cost of acquisition provision, this date. But if there are cases of shares or other, this date is going to affect the cost of acquisition provision. So if it is bonus shares means we got these shares without paying anything. That is technically free. But if you have been allotted the bonus shares before 1st April 2001, in that situation, the FMV on 1401 would be your cost of acquisition. The FMV on 1401 would be your cost of acquisition. Technically, suppose if I have received bonus share in 1995, so practically I did not paid anything because it's free. So company must have given me that share and I did not spend anything. If I transfer those shares now, then whatever I will receive, that would be my sale consideration. And the cost of acquisition, practically it is nil because I have received those shares free of cost. But there is a good provision. There is a provision which is beneficial to assessee that even you did not pay anything, still we will consider the FMV on 1401 for as a cost of acquisition in your hand. So that would reduce your capital gain. Suppose in 1995, you have received bonus share for, of course, nil rupees. In 2024, you are transferring those shares for 10 lakh rupees. So practically you did not pay anything, but because of this provision, now you can have cost of acquisition, which would be the FMV on 1st April 2001, which would be given in the question. Suppose if it is 2 lakh rupees, then your gain would be now 8 lakh rupees. If this provision does not here, you have to pay tax on 10 lakh rupees. Understood? If bonus shares have been allotted to you on or after 1st April 2001, then cost would be always nil. There would not be any cost at all. So the complete sale consideration would be your capital gain. We have some special provision also regarding the bonus share, etc. We are having some special provision also regarding the cost of acquisition of long-term equity shares, equity-oriented fund, bonus share acquired, allotted before 1st February 2018. We have special provision for this also, on which STT is security transaction tax has been paid. So we have a special provision for these kind of bonus share, etc., which we will discuss in detail in page number 44 from our notes. So till that, we have to skip that part. That is a special provision we will discuss later. But for the time being, now we can say if you have bonus shares before 1/4/2001, the cost would be the FMV. If it is on or after 1/4/2001, the cost would be nil. Clear? Now moving on to the other, that is right shares. So right shares are those shares, those you have received at less cost comparison to market value. Suppose in case of right shares, suppose the FMV is 100 rupees. That means if a new person is going to purchase that share from the market, the company will sell it at the rate of 100. But for the existing shareholder, the right price is 90 rupees. So if you are an existing shareholder of that company, so company will give you the priority. You have the priority to purchase those shares and even at the less of market price. So for the new shareholder, the price would be 100. But if an existing shareholder wants to purchase, the price is 90 rupees. So now suppose I am an existing shareholder and company offer me 1000 right shares to purchase at the rate of 90. The market value of those is 100. So as an existing shareholder, technically, or we can say practically, I have three options. Option number one, I can purchase those shares at 90 rupees. Okay. Option number two, I can refuse to purchase these shares. I don't want to purchase it, leave it. In that situation, no cost of acquisition because I did not purchase that asset. The third is, you must have heard this also, that you can renounce your right also. We can renounce our right to purchase. We are not renouncing or transfer shares, but we are just renouncing, we are just waiving, we are just transferring our right to purchase those right shares at some point or at some amount. Suppose in this example, 2 rupees per share. So either you can purchase those shares at 90 rupees, or you can refuse to do anything. And you have one more option, that you can renounce the right to purchase these shares to any new shareholder. So in these cases, what would be the cost of acquisition in your hand, or what could be the cost of acquisition in the hands of a new shareholder? Those cases we need to discuss one by one. And let me tell you, it's very simple. You can see the whole cost of acquisition diagram or provision is based on one thing. If you have paid something, that would be your cost. And if you did not pay anything, then cost would be nil. There are some exceptions also, like bonus share purchase before 1/4/2001. In case you did not spend or incur anything, but still there would be cost of acquisition. So now, in case of right shares, we are discussing the provision from the point of view of, first of all, old shareholder. Old shareholder means existing shareholder. And also, if that right share has been purchased by new shareholder. If you are an old shareholder, so either you are going to purchase those shares, the purchase price is 90 rupees. Now again, that 1/4/2001 case will be there. If that has been purchased before 1/4/2001, then FMV on 1/4/01 or purchase price higher would be your cost of acquisition. Clear? If you refuse to purchase or refuse to renounce the right, that case does not applicable in capital gain. So either if you purchase, that provision of capital gain would be there, and if you renounce the right, in favor of any new shareholder, then what has been incurred from my pocket? Nothing. So cost would be 0. Suppose you have renounced the right at the rate 2 rupees per share, and 1000 shares were there, and you have charged 2 rupees per share. So your sale consideration would be 2000 rupees. Understood? Your sale consideration would be 2000 rupees. And what would be your cost? Your cost would be nil. So in case of right renounce, the full consideration would be your capital gain, because you have not incurred anything. You have gained that right like a bonus. And now we will see from the point of view of new shareholder. Either the new shareholder would purchase these shares from the company directly at the market price, of course. So either you are going to purchase these shares from company directly, and the market price is 100 rupees, of course. So again, the situation will be the same. If it is before 1/4/2001, the cost would be FMV on 1/4/01 or the purchase price as above, that means 100, whichever is higher. If that is the case of on or after 1/4/01, purchase price as above would be your cost of acquisition. I hope it's clear. It's very simple. Now the interesting case is that, suppose the new shareholder went to the existing shareholder, which is our old shareholder, and asked him to renounce the right in his favor. Then he needs to pay to 2%. He needs to pay 2 rupees or whatever the consideration decided between those per share to the existing shareholder, and he needs to pay to the company also for purchasing that share. So in that situation, You have to purchase the right, and then you need to go to the company to purchase those shares. So what would be the cost of acquisition? The right renounce cost plus price paid to the old shareholder. So in that case, just a second. Okay. So in case of, if that has been purchased, right renounce price paid to the old shareholder, and in this example, so the 2 rupees which has been paid by the new shareholder to the old shareholder plus the price he needs to pay to the company would be the cost of acquisition. So in that case, 92 rupees would be the cost of acquisition in the hands of that right or a new shareholder. And if it is purchased before 1/4/2001, again, that 92 rupees or FMV on 1401 would be the cost of acquisition. If it has been transferred or purchased after or on 1/4/2001, then the 92 rupees would be the cost of acquisition. So we are considering 2 rupees paid to the existing shareholder and 90 rupees he needs to pay to the company for purchasing that share. So that would be 92 rupees. So that is the benefit to the new shareholder. If he purchases right from the existing shareholder, then he will get the shares at lower price. If he directly going to purchase that share from a company, he needs to pay 100 rupees to the company at least for the purchase of these shares. Now the provision for other asset. For all other asset, the provisions are again same. If it is before 1/4/2001, then FMV on 1/4/2001 or purchase price higher would be your cost of acquisition. If it has been purchased on or after 1/4/01, then purchase price would be your cost of acquisition. Suppose in case of your building, residential house will fall in this category, your jewelry, etc. all will fall in other categories. So except your goodwill of business, etc., goodwill of profession and shares, except these three assets, if there is any other asset which is non-depreciable, in that case, if it has been purchased before 1/4/2001, then always 1/4/2001 FMV or purchase price higher would be your cost. And if it is on or after 1/4/01, the purchase price would be your cost of acquisition. Now, if it's clear, fine. Just a second. Server is having some issue. Okay. So important clarification for cost of acquisition and cost of improvement. Goodwill of business, etc., in relation to a capital asset being goodwill of a business or a right to manufacture, produce, or process any article or thing. So we are discussing about the intangible asset case. The cost of improvement shall be taken to be nil always. So there could be only cost of acquisition in case of intangible asset. All kind of cost of improvement should be ignored. First clarification, very important. The next is again very important. It says land and building, those are non-depreciable cases, are two separate assets. So land is that plot area and building is that construction thing we consider as building. So they are technically two separate assets. Suppose if Mr. A purchased a complete constructed building on land, that would be considered as a single asset in the hands of Mr. A. That is possible. But suppose in the question, Mr. A purchased a land in 2012, and after some year, in 2016, he construct some building upon that land. In that case, there would be two separate assets in the hands of Mr. A. So when in future he will transfer these assets and the consideration has been given separately in the question that for land you received suppose 50 lakh rupees and for the building part suppose you have received 30 lakh rupees. Total consideration has been given 80 lakh rupees, but we have separate value has been given in the question for the land part and for the construction or building part. Then we have to calculate the capital gain separately. You have to calculate the land capital gain separate and you have to calculate the building capital gain separate, because in that situation your indexation provision would be different. For the purpose of land, you have to apply index, taking the index of 2012 as purchase year. For the purpose of construction, we have to take 2016 index. Even there is possibility that land could be long term and building or construction part could be short term. How it is possible? Suppose you purchase land in 2020 and construction complete in 2024 and you transfer it 2025. So this is more than 24 months. So this part would be long-term capital asset. But this is less than 24 months as per the definition of short-term and long-term. So this would be treated as short-term capital asset. So what I'm trying to tell you that if in the question land and building sale consideration and the purchase detail have been given separately, then you have to calculate the gain separately. Understood? Why? Because indexation provision would be different and even short-term or long-term asset nature could be different. Okay. So these are two separate assets for the purpose of capital gain. If land acquired before 2 years and building constructed within 2 years, then we have to calculate separate capital gain for both assets separately. So capital gain on land in that situation could be long term, and in case of building, it could be short term. Okay. Moving on further. If any asset non-depreciable acquired on loan, why I am repeating again and again non-depreciable? Because we have separate provision in case of depreciable asset under section 50. So that will include all these provisions that when they will be short term, what would be the indexation concept on it, etc. So all these clarification is for non-depreciable asset. So if any asset non-depreciable acquired on loan, then interest on such loan till the repayment will become the cost of improvement and will be indexed if long-term capital asset. So whatever is the interest part, that interest part need to be indexed. If it is a long-term asset, need to be indexed if till the amount of repayment of that loan, provided that interest should not be claimed under income from house property or deduction under section 80EE or 80EE. So if you have already claiming that interest under income from house property or any other section of income tax, then this benefit you cannot take. So if the question says that we have purchased a property on loan and we are paying the interest regularly and did not claim that interest under income from house property or interest in any other section, then you can claim that interest as cost of improvement under capital gain head. The interest allowed under section 24B, you can see that under income from house property or deduction under section chapter 6A, that cannot be claimed as cost of improvement under income from capital gain, because under income tax there is a universal rule. The rule says one deduction can be claimed once, no income can be claimed twice, no expenses can be claimed twice, no deduction can be claimed twice. So if you have already take the benefit under income from house property or under any other head of income, then this benefit you cannot claim under income from capital gain and vice versa. Okay. Then you can go through with this point, that is old provision. Any other capital asset where the capital asset become the property of the assessee before 1/4/2001. So we have discussed this other capital asset provision that was in the last of our chart. And it says if that is land, building, jewelry, etc. So what was the provision? The provision says If it is purchased before 1/4/2001, FMV on 1/4/2001 or purchase price higher would be your cost. If on or after 1/4/01, then purchase price would be your cost of acquisition. So exactly it has been explained over here. Cost of acquisition means the cost of acquisition of the asset to the assessee or the FMV as on 1/4/01 at the option of the assessee. So this FMV concept would be applicable only when the asset has been purchased before 1/4/2001. Like an example, suppose you have purchased some property for 30,000 on 1st January 1992. And FMV is 1,40,000 on 1/4/2001. So higher would be your cost of acquisition, that is 1,40,000. FMV would be in question given. Now, why we are discussing this point? Because a very interesting clarification for this point is over here. For all assets, we have to follow this concept, FMV or purchase price, whichever is higher for all assets. But if it is a case of immovable property, it's land, building, or both. If it is purchased before 1/4/01, the provision is still same. It says we will take the FMV on 1/4/01 or purchase price, whichever is higher. But there is one more additional clarification. In this immovable property case, FMV cannot exceed the stamp duty value, the government value of that immovable property. Suppose FMV on this date, on 1/4/2001, FMV is 15 lakh, 15 lakh. But the stamp duty value is 12 lakh. Then we have to compare 12 lakh with the purchase price. If stamp duty value is more than 15 lakh, like it's 18 lakh, then we will take FMV. But FMV cannot exceed the stamp duty value. If it exceeds, we will replace the FMV with stamp duty value. We have the example also. Now you can see, in case of land or building or both, the fair market value of such asset on 1/4/01 shall not exceed the stamp duty value wherever available of such asset on 1/4/2001. Example, you can see the above example. Suppose the stamp duty value of the property is 1,20,000 on 1/4/2000. So earlier the cost was, purchase price was 30,000 and the FMV was 1,40,000. In the above example, the purchase price was 30,000. So what we did, we compared it. But suppose if the stamp duty value in this example has been given 120, then FMV cannot exceed the stamp duty value. Then we will compare stamp duty value with purchase price. And in that case, higher would be your cost of acquisition. So it's a very, very important point for the purpose of your examination, that in case of land and building, you have to keep in your mind one additional clarification, which we just discussed. Now you can see what we have discussed with the chart regarding the cost of acquisition. You can see goodwill of business, tenancy right, intangible asset. Then we have the provision of goodwill of profession, then shares, and then other. That has been explained in detail in notes also. So you can go through with these notes also. If there would be any problem, any issue, you can discuss, you can ask me. We will solve that also. The all provision has been summarized over here. And you can see, in case of bonus shares or equity oriented fund, I have told you we have a special provision. If it has been allotted before 1st February 2018. So that provision is going to be discussed on page number 44 in detail with example. Okay. So everything which we have discussed in chart presentation is written over here. The chart presentation makes things easier for you to understand. So you should go through with this provision also, and exactly the same we have discussed in the chart. Okay. The right share concept, then long-term asset, before any other capital asset we have gone through, etc. Everything has been mentioned in this detailed provision. So that was the provision of cost of acquisition. Now, before going further, let me ask you some questions, and I will also give some homework also to you, so you can solve those questions. And those questions we are going to discuss in our next session. But before that, let me ask you some simple question, what we have discussed till now. One by one. Let's see who will answer. So this is our question number 1. And it says, which of the following will be treated as long-term capital asset after 12 months? So from the following asset, you have to tell which should be considered as long-term capital asset after 12 months. Mr. Ishan is saying option A. Shalini also saying option A. Arshada also saying option A. Well done. And the correct answer is, of course, option number A is the correct answer. Listed shares. Okay, Mrs. Anandruti saying A and B. No, unlisted share does not become long-term after 12 months. Okay, only listed share would become long-term capital asset after 12 months. Even if up to 12 months, that would be considered as short-term capital asset. Understood? Fine. Second question. The goodwill if the goodwill of a business, trademark or brand name, right to manufacture, right to carry on any business or profession, tenancy right, route permit or LUMARS is self-generated before 1/4/2001, the cost of acquisition of such asset should be, okay, Mrs. Julie saying C, Ishan is saying C, Almas also saying C, Shalini is saying C, Dhanush is saying C, Pooja is saying C, Nidhi is also saying C. Well done. The correct answer is, of course, C. So if in case of self-generated case of goodwill, etc., there is no impact of FMV on 1401. In the practical topic, it has always happened. I've also told you in the, I guess, residential status chapter, and when we were discussing the basic concept rate of taxes, there's a problem with practical topics that you will understand the topic when you will practice the question. So even when we were discussing the cost of acquisition chart, I believe many of you must be thinking it is very complicated. When 1/4/2001, we need to take the FMV, and in case of bonus share, some other provision. In case of right share, there's something else, etc., etc. But let me tell you, it is most easy provision. Easiest. Once you will solve 3 or 4 questions, you will feel, okay, that was very simple. And it's the reality. Until you will practice numerical thing, you won't be able to understand, even if you have learn all those provision by heart. But until you practice, you are not able to understand the provision easily. So now question number 3. Which of the following is not a capital asset? Rajveer is saying C. Okay. Pooja is also saying C. Shalini is saying C. Soumya is also giving answer C. And let me tell you, okay, Gayatri is saying D. All personal asset, no Gayatri, all personal asset is not regarded as not a capital asset. Only those personal asset, those are movable. That could be regarded as not a capital asset, because in which house I reside, that is my personal residential house, but it is a capital asset because it is not movable. So the correct answer is option number C. And you might be feeling that these are so simple question because everything is simple. If you have understood that clearly and you have revised it. So if you have revised these provision, I believe you must be feeling that these are very simple. Next, question number 4. Transfer does not include. Transfer does not include. Rajveer is saying B. Ishan is saying D. Somebody is saying B. Julie Kumari is saying B. Okay, so there is confusion. Some students are saying B and some are saying D. There is also someone, Sangeet Iswani, is saying C also. Okay. So the correct answer, it's very interesting. The correct answer is D. This is transfer, extinguishment. We have discussed the extinguishment regarded as transfer. And I've told you gift is also transfer. Gift includes in the definition of relinquishment. I have told you, but later on it would be exempted transfer under section 47. And I have told you, if somebody asks you whether gift is included in the definition of transfer, you have to say yes. But capital gain is not applicable due to exemption given by section 47. But you cannot say that gift does not include in the definition of transfer. So this is transfer, and sale is also a transfer. So all of above includes in the definition of transfer. So there is no transaction which is not regarded as transfer in this question. Understood? Well done. Next, the cost of acquisition of the right shares to a person who purchased the right to acquire the share from the existing shareholder shall be. Tell me which is the correct answer. Read it carefully and then answer only. Ishan is saying C. Soumya is saying C. Almas is also saying C. Rajveer, okay. Shalini also saying C. Yes, the correct answer is C. Because if you are a new shareholder, you need to purchase existing shareholder renounce right, and then you need to pay to the company some amount to purchase those shares. So the correct answer is option number C. Price at which these shares are offered. That means in our example that was 90 rupees plus the amount we need to pay to the person renouncing the right. That means 2 rupees. So 92 would be the cost of acquisition in the hands of the new shareholder. Well done. Now, goodwill of a profession, which is a self-generate personal, is transferred their will. What is the correct option? Rajveer is saying B. Arshada is saying D. Almas is saying B. So if goodwill of a profession which is self-generated and personal, if it has been transferred, then there would not be any capital gain. There would not be any capital gain because it cannot be transferred. So something which cannot be transferred, that cannot result in a capital gain. So be a capital gain? No. Be a short-term cap gain? No. None of the above? No, because it cannot be considered as a capital gain because you cannot transfer it. Okay, next question. Rajat purchased a car for his personal use for 5 lakh in April 2024 and sold the same for 550 in July 2024. The taxable capital gain would be which one? Prityanshi is saying A, Pooja is saying A, Ishan is saying C, Almas is saying A, Rajveer, Nidhi, Shalini, those are saying A. Why A? Okay, Miss Harshada will tell why A. Write it down, Harshada, in short. Why you are saying the correct answer is A? Correct. Very nice, Harshada. Personal and movable. So car is a personal, and of course we know that it is movable. So if there is a personal and a movable asset, that is not a capital asset. So there cannot be any capital gain. Well done. Next, what is the cost of acquisition if a land is purchased on 1st April 2010 for rupees 10 lakh? Commission paid on purchase was 10% of purchase price and FMV on 1/4/2001 is 12 lakh rupees. So what should be let me tell you, the commission you paid the time of purchase would form your part of purchase price. You must have heard that anything which you spend up to put to use of an asset, that would be the past part of your asset. So what is the correct answer? Somebody, Sahil Kumar is saying C. Harshita also saying C. Nidhi is saying A. Riyanshi is saying C. Soumya also saying C. Okay, so why it's not 12 lakh rupees? Why not? Who will tell why it's not? We have discussed that the price should be FMV or purchase price, whichever is higher. Correct, Harshada. Very nice. That FMV on 1/4/01 or purchase price, whichever is higher, is applicable if asset has been purchased before 1/01. But you have to read that the date of purchase is 1/4/2010. So this concept has been gone. Only purchase price need to be your cost of acquisition. So after solving these questions, are you feeling that is difficult provision? The cost of acquisition concept is difficult anyhow. Exactly. When we practice those kind of questions, you will feel that is easiest. So that was question number 8. This is question number 9, and this is your homework. You can take the screenshot, whether right now or later, as you want. This is a question, and this is your homework. In the next class, I will discuss. We still did not read the provision. In today's class, I will complete this concept, Manjula J. Shah concept, we will discuss. So after today's class, you will be able to solve these questions. So this is your question, homework number 1. You can take the screenshot of this question also later. I will upload this sheet also, don't worry. But it takes 3 or 4 hours to be uploaded. So you can take the screenshot and you can solve it after when we will discuss the today provision. This is your homework number 2. This is your third question. And this is your fourth question for homework purpose. 8th का आंसर कौन पूछ रहा है? 8th है हमारा 8th का आंसर 11 lakh. C is the correct answer, Nidhi. Okay. So 9th question screenshot you can take. This is 10th question screenshot you can take. 11th question you have in front of you. And this is 12th question. Okay. So this 9, 10, 11, 4 question you have to solve it by yourself. You try yourself. If you won't be able to solve, I will solve it for you in our next session. So these all 4 questions related to Manjula J. Shah case law. What is that Manjula J. Shah concept, etc. that we will discuss in today's class. Before ending of today's class, we will end this concept. So you would be able to solve these questions. Okay. Moving on further to the provision. Section 47 now we are discussing, and of course the Manjula J. Shah concept is connected to section 47. So when we will complete our section 47, you will be able to understand this Manjula J. Shah concept. Okay. So now section 47 says cases in which transfer is not regarded as transfer. So in the definition of transfer, government includes gifts which they wanted not to be included. Because in case of gift, there will always be loss. Gift, donation, partition, etc. So there were certain cases which has been included in the definition of transfer. But after that, department realized that in this situation, we do not have any tax benefit, but our revenue collection will be lower. So later on section 47, exempted those capital gains. So these are transfer, those have been included in the definition of transfer. But later on, department says that these are transfer, but we will not regard or we will not recognize these transfer as transfer for the calculation of capital gain. So we will not calculate capital gain in these case of transfer. So we can say, technically we can say they are kind of exempted capital gain. So we are discussing some situations, some cases of transfer in which they fulfilling the definition of transfer. But even in that situation, we are not going to charge capital gain under section 45 in these cases. So technically, these are technically exempted capital gain. First one, distribution of asset at the time of partition of HUF. So at the time of partition of HUF, whether partial or full partition of HUF, if asset has been distributed to the members, that's a kind of a gift because we do not take the consideration. It is a voluntarily waiver of right. So technically, it includes in the definition of relinquishment. But again, because in the case of partition, HUF would not receive anything in return. So the sale consideration would always be zero and there would be cost. So there would always be loss. And if we recognize this loss, the gain and the tax collection would reduce. So income tax said it would be exempted capital gain. So partition of HUF, if the question says there is a HUF, an asset has been transferred at the time of partition of this HUF, you need not to apply capital gain provision. Understood? It's a kind of a relinquishment. Same case, capital asset transfer under a will, gift, or irrevocable trust. Will means at the time of death, if you have decided that after the death, the asset should be transferred to someone else. That is a will. Again, no consideration, relinquishment. Gift, we all know, no consideration, relinquishment. Irrevocable trust, that means donation. No consideration, that means not going to treat these also as capital gain chargeable transfers. These are transfer because includes in the definition of relinquishment. But if we try to calculate gain in these cases, there will always be loss. So again, these are exempted. So if there is a question which says that Mr. A transfer a house as gift to his brother, Mr. B. So you can see now there is a capital asset and gift is relinquishment. That means transfer. So this satisfies the definition of capital asset and this satisfies the definition of transfer. But because of section 47 include point number 2, so we will not calculate any capital gain in this gift transfer year. Suppose the gift has been done in 2024. So there would not be any applicability of capital gain chapter. You can write it down, exempted capital gain, or these are the transfer not regarded as transfer under section 47. So when capital gain would charge in this case, when Mr. B sell this property in future, at that year, if suppose if Mr. B also give this property to C, again no capital gain. C transfer to D as a gift, no capital gain. Somebody, when someone will transfer that property as a sale, then in that year, capital gain need to calculate. So in that year, we have to apply the capital gain provision when that particular asset is going to transfer by way of sale, etc. In that year, we have to calculate gain, and in that year, Manjula J. Shah case would be applicable. I'm not telling you what is Manjula J. Shah. We will discuss it with an example, but I'm just telling you when Manjula J. Shah or when capital gain provision needs to apply. So until these assets are going to gift or donate, etc., there would not be any capital gain applicability. It will be applicable when there will be a normal transfer. Understood? So at the time of partition of HUF, no capital gain. If it is a gift, it's a will, is an irrevocable trust, no capital gain. But this benefit of gift, etc., would be applicable if gift has been made by individual or HUF. If a partnership firm gives any asset to anyone, this exemption would not be applicable. The provision says any transfer of a capital asset by an individual. So this exemption is only when the asset has been transferred by an individual or HUF under a gift or will or irrevocable trust. Then capital gain would not be applicable. This note is connected to the up to 31st March 24. So you can skip it. Do not read it. So you will get confused. Again, this provision also applicable up to 2024-25. Now not applicable, already included in the above provision. Now the simple provision is this. The benefit of gift is only available to individual HUF. Earlier, it was available to all persons. So up to 31st March 2024. That was your financial year 23-24, assessment year 24-25. Till that year, if any gift is provided by any person, whether it's individual, HUF, partnership firm, company, to anyone, exemption was there. But from financial year 24-25, which is applicable for your attempt, if the gift has been transferred by individual or HUF, then that would be exempted. If it has been transferred by any other person except individual HUF, then there would not be any exemption. There would be capital gain. Suppose a company provide shares under ESOP to its employee. ESOP, you must have know about this, employee stock option plan. So in that case, if company gives shares to employees under ESOP plan, so what will happen? Sale consideration, we will take the FMV of these shares. That would not be exempted capital gain. The FMV could be treated as the sale consideration. So if shares gifted by individual HUF to anyone, no capital gain. But if any asset has been transferred by other than individual HUF to anyone, that will constitute transfer. In that case, the FMV would be taken as sale consideration. Okay. So we have discussed the partition of HUF exempted, gift, will, or irrevocable trust. If transfer by individual HUF, that is also exempted. Now the third case is amalgamation. In case of amalgamation, by amalgamating company to amalgamated company, provided amalgamated company is an Indian company. So suppose there is a company A Limited and there is a company B Limited. A Limited is amalgamating into B Limited. So A Limited is amalgamating into B Limited. So A will be called amalgamating company. Amalgamating company would be A Limited. And B would be called amalgamated company. Clear? So in case of amalgamation, if any capital asset, CA, not chartered accountant, capital asset, if any capital asset has been transferred by amalgamating company to the amalgamated company, then there would not be capital gain provision applicability. No capital gain. Provided B Limited, that means amalgamated company should be Indian company. Suppose A Limited transfer is capital asset to B Limited in the process of amalgamation in the year 2022. So what will happen? No capital gain concept applicable. When capital gain will be applicable? If B Limited transfer that asset into future, sale into the market, anything else. So if suppose B Limited transferred that capital asset, which is received by B from A in future, in that year, capital gain provision would be applicable. In the same way as we discussed in case of gift, etc. So in case of gift, partition, amalgamation, in that particular year, no capital gain provision applicable. Why? Because these are exempted capital gain. Then when it will be applicable? In the year asset will be normally transferred, taxable transfer, not exempted transfer. Understood? So if the amalgamated company is Indian company, then there would not be any capital. So we have two provisions regarding amalgamation. One is capital asset transfer in case of amalgamation from amalgamating company to amalgamated company, and the second also in case of amalgamation. What is the second one? Let me tell you. So we have discussed the provision of amalgamation. A Limited transfer its capital assets to B Limited. In the process of amalgamation, so if B Limited is an Indian company, there would not be any capital. So this transfer is exempt. Clear? Now, second case also is for amalgamation. One more benefit. Again, A Limited, B Limited. So during amalgamation, capital asset generally transfer and as well as shares also transfer. How? The shareholder of, you all know that in case of amalgamation, now A Limited would be ceased to exist. A Limited would be finished. And the business of A Limited would be carried on by the B Limited. So what will happen? The shareholder of A Limited company, those are having shares of A Limited in their hands. They are having shares of A Limited. So now because A Limited business is getting merged into B Limited, so now A Limited existence is going to cease. So in respect of shares of A Limited, now they will get in exchange the shares of B Limited. So now you can see shares are our capital asset and they are getting exchange. So does exchange fall in the definition of transfer or not? Shares are capital asset as per the definition of capital asset. Does exchange fall in the definition of transfer or not? Yes, exactly. Well done. Exchange included in the first point of transfer definition, which says sale, exchange, relinquishment. Why we are calling it exchange? Because you are giving shares of A Limited and in exchange of shares of A Limited, you are getting shares of B Limited. So you can see there is capital asset and there is exchange. So capital gain should be applicable, but again, it is exempted. So the provision says when capital asset like building, machine, etc. is transferred during amalgamation, no capital gain on these assets. And in amalgamation also, as well as asset and shares are also going to be exchanged. So again, the shares are also a capital asset and exchange is transfer. So capital gain should be applicable, but that is exempted capital gain. And no capital gain would be applicable, but two conditions should be satisfied. First is same, that B Limited should be Indian company. One new condition is here, that the shareholder of A Limited will get only shares in the exchange. No other asset should be given other than share. Like shareholder of A Limited is giving their share. And in exchange, they should receive only the share. No money, no other consideration, no other asset. Matlab exchange should be against shares to shares. No other asset should be in exchange. Except shares. Understood? But it is an exception. There is a case in which, so if these two conditions fulfill, the capital gain not applicable, exempted. But second condition is an exception. What is exception? Suppose the exchange ratio has been decided like this, that against 3 shares of A Limited, you will get 1 share of B Limited. So suppose somebody is having 300 share of A Limited. So in exchange, he will receive 100 share of B Limited. So he will only should receive the 100 share of B Limited. You cannot pay anything else. But suppose somebody is having 100 share of A Limited. Now in exchange, he needs to receive 33.33 shares of B Limited. Now, this is a problem. He can receive 33 shares, but 0.33 shares cannot be received. So for if fraction of share, in case of fraction of shares, that means for 0.33 part, you can pay monetary or any other asset. That is allowed. But for 33 shares or 100 number of shares, you cannot pay anything else except shares. So for fraction of share, you can pay him any other asset like money, etc. Still exemption would be there. But if even you pay anything other than fraction of share, other than shares, like in case of 33.33 shares, company say we will pay 30 shares and monetary payment for 3.33 shares. So this is not allowed. Only 0.33 part monetary payment is allowed. If they does so, then capital gain would be applicable. They need to pay the tax. Understood? So these conditions should be fulfilled. You can see any transfer by way of shareholder in the scheme of amalgamation of the shares held by him in the amalgamating company, provided amalgamated company is an Indian company, transfer is made in consideration of allotment of share in the amalgamated company. So allotment should be only of shares. No part of consideration would be other than shares. Consideration other than share is allowed only in case of fraction of shares. Got it? Next is, we have example also. M held 2000 share in a company ABC Limited. This company amalgamated with another company during the previous year 31st March 25. Under the scheme of amalgamation, M was allotted 1000 share in the new company. The market value of these shares allotted is higher by 50,000 than the value of holding in ABC Limited. Assessing officer proposed to treat the transaction as exchange and to tax 50,000 as capital gain. Is he justified? What should be the correct answer, student? Is he justified or is he not justified? So can assessing officer tax this 50,000? Assessing officer is saying that in the exchange process, you are receiving extra 50,000 rupees value. So can he tax or not? Anush is saying not justified. Because why not justified? Because it is not transfer. Because they have received shares, again exchange of shares only. And this is an amalgamation case. So there should not be any capital gain applicability. Clear? You can see the answer in the above case. Assuming that the amalgamated company is an Indian company, the transaction is squarely covered by the exemption. So the officer is not justified. Clear? So we have discussed till this point. After point number, we have left with 5, 6, 7, 8, 9, 10, 11, 12. After completing these 12 points, then we will move to Manjula J. Shah cases. And let me tell you, these all 12 points are just transactions in which transfer will not be regarded transfer. So when it will be regarded as transfer? On the time of partition, gift, amalgamation, not a transfer. But in future, when you will transfer these assets against monetary payment, etc., in that year, capital gain provision would be applicable. So we have discussed 4 transactions. Remaining 8 transactions are also same. They are considering some event and they are saying this event also not regarded as transfer in this year. You can take tax when the asset is going to transfer in future. So what are those 8 remaining cases that we will discuss after the short break? So till that, you can have your tea, coffee, etc. So Ashok sir, can we take a break of 10 minutes? have your tea, coffee, etc. So we were discussing the provisions of Section 47. Miss Harshada is asking, can shareholder of amalgamating company buy extra share of amalgamated company if they want? Yes, they can purchase it, but it is not in the scheme of amalgamation. In the scheme of amalgamation, shares will be allotted as per the ratio decided. But if any shareholder wants to purchase extra share, they need to purchase it out of market in the market, but not due to the scheme of amalgamation. Okay. So moving on to the provision, as we discussed, that in these cases, capital gain would be charged in the year when they will transfer it normally. And we have discussed last 4 cases. One is partition of HUF, second one for gift, will, or irrevocable trust. And that would be by individual HUF. Then 2 cases of amalgamation we have discussed. Now, point number 5, transfer of a capital asset by holding company to subsidiary company. Now, you can see if in case of holding in subsidiary, transfer of a capital asset by holding company to subsidiary company or vice versa. Again, there would not be any capital gain if a holding company transfer it asset to subsidiary or subsidiary transfer it asset to holding company. There would not be any capital gain provided 2 conditions need to be satisfied. First one, the transferee company should be an Indian company. The transferee. That means if holding is transfer asset to subsidiary, then subsidiary is the transferee and holding is transferor. So subsidiary should be Indian company. But if the case is reverse, that subsidiary is transferring asset to holding company, in that situation, holding company should be Indian company. So to whomsoever is the receiver, that should be Indian company. So the person who is receiving the asset, the person who is the transferee, that should be considered as an Indian company. The first condition need to be fulfilled. The second, that holding should held entire share capital of subsidiary company. Entire share capital means 100% of share capital should be held by the holding company of subsidiary company. Equity as well as preference share capital. That means only one shareholder would be there, and that is the holding company. So if the holding holds entire share capital of subsidiary company and the transferee company is an Indian company, in that situation, if the asset has been transferred from holding to subsidiary or subsidiary to holding, there would not be any capital gain. When there be capital gain, when that transferee company in future transfer that asset in normal course, in that situation, transfer definition would be applicable and there could be capital gain. Next is any transfer of capital asset being work of any art, archaeological, scientific, collection, book, manuscript, drawings, paintings, or photograph or print to the government university. Very important thing is government university. Suppose I am having an antique painting or manuscript or any art, archaeological work. I have something related to antique thing. And if I transfer that asset to the government, university, national museum, national art gallery, or any other public museum, in that situation, there would not be any capital gain. Capital gain would be exempted. Next is any transfer of FCCB. Now we are discussing about some securities. FCCB is foreign currency convertible bonds. So if you issue convertible bonds in India, they will call convertible bond. But if you issue convertible bonds outside India in their currency, so that will be called foreign currency. So that is called foreign currency convertible bond. So that means those kind of convertible bonds, if that has been issued outside India, they are called FCCB. So suppose there is an Indian company, those issued some bonds in India, convertible bond, we will call them convertible bond. And that Indian company issues some bonds outside India in some other country in their currency. So that would be called foreign currency convertible bond. In the same case, ADR, American Depository Receipt. If an Indian company issue shares, equity shares in India, we call them equity shares. But if that Indian company issue equity shares in India and against those equity share does not going to issue to the public. A custodian hold that equity share in India on behalf of that company. Suppose some bank. So an Indian company issue equity shares and they appoint a custodian bank in India, any bank, like suppose Bank of Baroda. They appointed Bank of Baroda as a custodian bank. So all the equity shares should be held by the Bank of Baroda in India. And against those equity share, depository receipt is going to be issued in America. So another bank would be appointed in America, another custodian bank. So there would be a company, there would be an Indian custodian bank, there would be overseas custodian bank. So custodian could be a bank or merchant banker depending upon the policies. So Indian company issue equity share and it is held by that Indian custodian bank. And against those equity shares, they issue depository to that overseas bank. That would be in America. And these depository is issued in America. So now these depository receipt would be called American Depository Receipt. So what is exactly American Depository Receipt? In short, in a layman, I can say, if an Indian company issue equity shares and hold those equity share in India, against those, on the custody of those equity share, depository receipt, if issued in America, that is called ADR. And if it is other than America, it is called GDR. So ADR is American Depository Receipt, and this is called Global Depository Receipt. The difference between an equity shares and a ADR is only one. There is no voting right on ADR and GDR. So voting right does not transfer. All economic benefit like bonus share, dividend, right share, etc., would be given to those American Depository Receipt holder and a GDR holders. But they cannot exercise the voting rights. So FCCB is foreign currency convertible bond issued outside India. It's a kind of a security issued outside India. ADR, GDR is like equity shares issued outside India, but they do not have the voting rights. Now we have also rupee denomination bond also. So if we issue bonds outside India, but in our rupee denomination, that is called rupee denomination bond made outside India. So now what's the situation? In all these four assets, FCCB, ADR, GDR, and rupee denomination bond, those are issued outside India. In these all four assets, if what would be generally happening, that the buyer would be a non-resident because it is issued outside India. So the investor would be non-resident. So suppose ADR has been issued outside India and America, and suppose a non-resident purchased those ADR. And after some time, he transferred those ADR to another non-resident. He is also outside India. The most probability is this, that ADR is going to be issued outside India. And after purchasing it by a non-resident, that non-resident again going to transfer that ADR to some another non-resident. So that transfer would not be regarded as transfer and not chargeable to tax. So if FCCB, ADR, GDR, and rupee denomination bond, we can say any currency, any security, which is issued outside India, purchased by a non-resident. And if that non-resident transferred that security again to a non-resident outside India, that would be outside the purview of taxability under capital gain. So the main condition you need to understand, these should be transferred outside India by a non-resident to another non-resident. So these three conditions should be fulfilled. So if any security issued outside India, and after that, if a non-resident transfer it to another non-resident outside India, no capital gain applicability. There are some more security also we're going to discuss. Those are also having the same concept. 8th point. Point number 8. Any transfer of capital asset. Now we have discussed the provisions of amalgamation. Now after amalgamation, we are going to discuss the provision of demerger also. And the same concept applicable. In case of amalgamation, there were two exemptions. One is transfer of capital asset from amalgamating company to amalgamated company, and exchange of shares from the shareholder of amalgamating company against the shares of amalgamated company, provided the amalgamated company is Indian company, and only shares would be allotted in exchange of share, except in case of fraction of share. The same 2 point is copy paste in case of demerger also. Now in case of demerger, suppose there is a Limited, suppose is a demerged company, and B Limited is resulting company. So if a demerged company transfer it capital asset to the resulting company, then there would not be any capital gain if resulting company is in Indian company. Understood? Same concept like amalgamation. And the 9 point also exactly same. If A Limited, which is a demerged company, and B Limited is the resulting company, the shareholder of demerged company will receive the share of resulting company in exchange. Same concept. So again, that exchange would be exempted if two conditions fulfill. First of all, the resulting company should be an Indian company, and only shares would be allotted against exchange of shares. No other asset should be transferred, except in case of fraction of shares. So again, if these two conditions fulfill, there would not be any capital gain in case of demerger also. Clear? So we have discussed 9 points regarding the exempted capital gain. We have left with 3 points. After that, we will discuss the concept of taxability of these cases when they will transfer these assets in future in normal transfer. In that situation, Manjula J. Shah case would be applicable. Next point is just same like FCCB, ADR, GDR. Now this is regarding for any government security. So any transfer of capital asset being a government security by one non-resident to another non-resident outside India. Same concept. Any government security which is issued outside India, and now one non-resident is transferred that security to another non-resident outside India. In that situation also, there would not be any capital gain. 11th is a specific bond. We are talking about any redemption of sovereign gold bonds under the gold government scheme by an individual will be exempted from capital. Now the last point, conversion of gold into electronic gold receipt or vice versa. Any transfer of a capital asset being a conversion of gold into electronic gold receipt issued by a vault manager, or conversion of electronic gold receipt into gold, does no capital gain on conversion and reconversion. So this is also a new scheme. So in all these 12 cases, the concept is same. Now understand the concept, because in the examination, the probability of framing question is very high. from these 12 points. So in these 12 points, अब बच्चों का अलग ही चल रहा है सर. This point number 7 is not in the module. It's creating module में 15 points. So point number is changed in the study material, but they all concept in your study material. So what I told you when we were discussing this chapter or another chapter, whatever we are discussing, please focus on that. Once you will read full chapter of capital gain, you will find every point somewhere is there. I am trying to managing those points in a way. In study, it is section wise description, but I am trying to make you understand the provision connection wise, because now we have discussed the cost of acquisition. Then we have to understand the capital gain concept. Without capital gain concept, if I'll start you to teach compulsory acquisition, and in that compulsory acquisition, suppose Manjula Jesha case is applicable, then you won't be able to understand what and how we are solving it. So I am teaching you in a way so you can connect all the provision one by one. So just stay with me. Whatever I am teaching you, just try to understand it. You will find all topics somewhere or else in the study material. Okay. So in those all 12 cases in which we have discussed the partition of HUF or gift cases we have gone through, 2 amalgamation cases we have gone through, 2 demerger cases we have gone through, 2 security cases like ADR, GDR, and government security was there. Those have been outside India. Government bonds, sovereign bonds, and that electronic receipt case. One case is holding in subsidiary, and one case is when you transfer any manuscript or antique thing to the government or museum, etc. Fine. So all these 12 cases, these are exempted capital gain. So in all these cases, when amalgamation happened, demerger happened, gift happened, partition happened, etc., in that year, there would not be any capital gain. If these transactions happen as a transfer, there would not be any capital gain in that year. So when capital gain provision would be applied, that would be applicable. In the year, those assets, those have been exempted if transfer normally. Suppose this asset has been gifted in this year, so there will be no capital gain. Suppose this asset has been gifted again no capital gain, exempted. But suppose if this asset has been sale and we have received some monetary consideration, so if that asset has been transferred in a case which does not fall in the definition of exempted capital gain, in that year, capital gain provision would be applicable. Now, how they are going to applicable? Now we are discussing those provision one by one. I am telling you with the help of an example. And this is very important because there's a good thing that all 12 cases you can solve with the same provisions. The solution of all these 12 cases would be the same. So in the examination, if any of these 12 cases falls, you can solve those cases with the help of one solution. And what are the solution? How we need to solve it? Let me tell you with the help of an example. Suppose there is Mr. A who purchased a building for rupees 10 lakh in the year 1990. Clear? And let's take a date also. Suppose 4th May 1990. He has done a cost of improvement of rupees 1 lakh on this building on 4th May 1995. Clear? He has also done one cost of improvement of rupees 2 lakh rupees on 4th May 2002. Now this asset have been gifted to his son on 4th May 2010. At this time, the FMV of this property was 50 lakh. His son also incurred a cost of improvement of 3 lakh rupees on 4 May 2015. His son also gifted this property to his brother on 4th February 2020. FMV suppose 17. Clear? Now his brother sold this property to Mr. M on 4th May 2024 for rupees 101 lakh. Expense on transfer was 1 lakh rupees. FMV on 1st April 2001 was rupees 12 lakh. Now you need to calculate the capital gain. So this is the situation. This is the question what we are going to solve. And you can see in this question, we have include the FMV concept also. We will understand how to calculate the cost of acquisition, etc. So we will read this question one by one and we will solve it accordingly. So first of all, I have always told you, whenever you solve a question under income tax, you have to write it down that what we are actually solving. And we have to write it down, computation of capital gain in the hands of, तो उनके नाम रख देते हैं. His son name was B and brother name was C. Clear? And this was A and this is M. Clear? So the capital gain needs to be calculated in the hands of assessee. Always we need to calculate the income or tax in the hands of assessee. So who should be the assessee out of these 4 persons in this question? What name should I write it down that should be called an assessee? So computation of capital gain in the hands of, somebody is saying C, Harshada is saying M, okay, Nidhi is saying A. So somebody has said M, somebody is saying A, somebody is saying C, and Harshada Singh is saying Ori. Sorry ki jagah she is saying Ori. Okay. So assessee would be always that person who receive money. This is the very basic thing to understand who is going to be the assessee. So does Mr. A received any money? No. Does Mr. B received any money? No. C received the money because C sold it to Mr. M. So assessee would be Mr. C. In the assessment year. Now, which is going to be my chargeable capital gain assessment year? Now you should understand, Mr. A gifted this property in 2002. So that is section 44 exempted case. And because it is section 44 exempted case, so we are not going to calculate anything in the year 2002 because that is exempted capital gain. Again, this is gifted to his brother in 2015. That is again a non-taxable case. It is an exempted case under section 47. So again, we are not going to calculate anything in the year 2015. But yes, because this asset has been sold to Mr. B in this year, so that is going to be my chargeability year in which I need to calculate the tax and the chargeability. So my assessment year would be 2025-26. Any problem to anyone? This is simple. Now the other thing, after that, what we have to find it out in a question to solve. The first thing is period of holding. To find out the nature of asset, the period of holding, we have to calculate. So period of holding generally means what I'm saying, listen it carefully. Generally, period of holding means the time duration when assessee acquired any asset till the time he transfer it. Assessee in normal cases. But section 47, all these 12 cases, there are special provision. The section 47, 12 cases, period of holding is having a special provision. It says that this transfer, when asset A has been transferred to B, we did not consider it as transfer. When B transferred to C, according to us, there is no transfer. Exempted transfer means there is no transfer. So technically there is no B, there is no C. Because when A transferred to B, for us, there is nothing like transfer happened. So we are assuming it 0. No B is there. So still asset is having with Mr. A. Very interesting provision. When B transfer to C, again it's an exempted capital gain. When something is exempted, why we will consider it as a transfer. So even asset has been from B and to C. So according to us, there is no B, there is no C, there is still A exist. Because he purchased it initially. So when he purchased, he become the owner. When he transferred to B, that is exempted transfer, 0. When he transferred B to C, that is exempted transfer, 0. When C transferred to M, that is a transfer. And because there is no B and no C, so the transaction technically running from A to M. The person who have actually incurred something to acquire that asset, that was Mr. A, who purchased it initially, and the M, who is now purchasing it as a normal transfer. So there is special provision in case of section 47 transaction that if that asset has been transferred normally in future, as in our case, it has been transferred in 2020 or 26, the period of holding would be from the previous owner, not from assessee. Special provision is here. Previous owner till transfer. And previous owner would be, who is the previous owner? A is the previous, who has actually purchased that asset. Suppose Mr. A also get that asset from his father. Suppose his father is F. Mr. F gifted to Mr. A on 4/5/1990. Then we have to take Mr. F. So that information must also have given in the question. Then when Mr. F has been purchased. So because Mr. A purchased and we are now assuming that A transferred to M because B, C technically does not exist. So if you assume like this, all those transactions, those fall under section 47. According to the technicality of provision, you assume those information irrelevant. Suppose now there is no B. For the purpose of assessee, we need to write it down name of C because the provision says the name of assessee should be there. But for period of holding, forget about all other person. Those are between these two transactions. So now period of holding would be from 1990 till 2024. So that would be a long-term capital asset. First thing. Now we need sale consideration. The sale consideration has been given in the question, that is 101 lakh. It's simple, normal concept. Now let's expense on transfer. So expense is 1 lakh. So technically net sale consideration is 100 lakh. So the net sale consideration is 100 lakh rupees. We have gone through with this provision earlier. Now we have to find out the cost of acquisition. Why we need to find out the cost of acquisition? Because it is a long-term capital asset. And it has been transferred before 23rd of July also. Asset has been transferred before 23rd of July 2024. So we have to apply the indexation provision for the calculation of GTI. If it is on or after 23rd July, then no indexation required, but we have to apply the indexation over here. So now for the purpose of cost of acquisition. So generally we take the cost of acquisition, which is paid by the assessee. But now we only need the name of Mr. C because tax need to be paid by him, because the reality, in practically, he received the money from Mr. F. So he needs to pay that. But from the point of view of special provision, the first special provision in case of section 47, when you will transfer that asset in future, the period of holding would be counted from the previous owner. The second special provision is for cost of acquisition. The cost of acquisition also need to be taken from previous owner point of view. Not from B, not from C, they does not exist. That's why the FMV, etc., everything is irrelevant. It just to confuse you. So the two special provision, we have three special provision to calculate gain in case of section 47 transaction. Those have been transferred in future. First special provision, period of holding would be taken from the previous owner. The second provision, the cost of acquisition also need to be taken from the point of view of previous owner, which is Mr. A. So if we need to take the cost from the point of view of Mr. A, because B and C did not pay anything, they did not incur anything, and they are irrelevant for us. So cost of acquisition, if you take from the point of view of Mr. A, so Mr. A purchased this property before 1/4/2001. And if it is before 1/4/2001 and it's a building, so we have to take the FMV on 1/4/2001, which is given in the question 12 lakh, or purchase price, that is 10 lakh, whichever is higher. So cost of acquisition would be 12 lakh. If in this question, suppose on 1/4/2001, stamp duty value also given 11 lakh rupees. Suppose 1/4/2001 stamp duty value also given. So you know FMV cannot exceed the stamp duty value. Then we need to take the cost 11 or 10, whichever is higher, that would be 11. But we are just not taking it. We are assuming there is no stamp duty value given. So we are taking only FMV. So now cost of acquisition is 12 lakh rupees. Now we need to index it. Index cost of acquisition. Now a very interesting thing is going to happen. Understand it very carefully. When you are going to calculate the index cost of acquisition, let me change the color of pen because this is very interesting. So for the purpose of index cost of acquisition, you must have remembered that what the formula says. The formula says cost of acquisition multiplied by transfer year index and divided by the year of index, the asset held by or purchased by assessee. Assessee or 1/4/2001 to index, whichever is later. Remember, this was the case. Now, according to this formula, now I have to find out the index cost of acquisition. A very interesting thing is going to happen. The cost of acquisition is 12 lakh, correct? The transfer index is 363. And now, which index should be here? The formula says the year of purchase by assessee or 1/2, whichever is later. So we were taking the period of holding from the point of view of Mr. A. Mr. A is not assessee, he is previous owner. The cost of acquisition we took from the point of view of previous owner. That is Mr. A, not assessee. But the formula says you have to take the index for the purpose to divide from the point of view of assessee. And who is the assessee in this question? C. That's why this is important, that you should write down the assessee name over here, not Mr. A, but he is the assessee C. So technically, as per the formula, we have to take the index of the year when this asset is held by assessee, which is Mr. C. And that is here this. C held this property in 4th May 2020. So we need to take the index of 20-21. As per the formula, we cannot help it because the formula says you need to take the index of assessee or 1/4/2001, whichever is later. So in this case, later is of course 20-21. So I have to see what was the index value of financial year 20-21. So in 2021 financial year, the index value is 301. So the index value is 301. Clear? So because it's 301, so my index cost of acquisition would be 14.47. Yes, it is 14.47. Clear? Now, we have to find out the cost of improvement. How much the cost of improvement? Because I need to reduce the index cost of improvement also. You can see the index cost of improvement. We have done the improvement in the year 1995. Any improvement which is before 2001 is irrelevant. So we have to ignore it. One improvement has been done in 4th May 2002. That is for 2 lakh rupees. So if you'll go with the provision of cost of improvement, then you can see there was a point which has been written just over here. Cost of improvement incurred before 1/4/2001 will be ignored, but cost of improvement done by assessee or previous owner, anyone, assessee or previous owner, both are liable to be deducted if that has been done after 1/4/2001. So we will reduce both cost of improvement in done by previous owner or the assessee. So previous owner has incurred 2 lakh rupees. The formula would be 363 and divided by the index of 2002-03. That would be 2002-03 index was 105. So this index 105. So my index cost of improvement would be 2 into 363 divided by 105. So that will come 6.91. We have one more cost of improvement done by Mr. B on 4th May 2015 for 3 lakh rupees. These need to be indexed also, and that is 2015-16 index we need. In 2015-16, the index was 254. That would be given in question, do not worry, 254. That is now 4.29. I guess we have included all the cost of improvement. Yes. So now if you see the answer, the capital gain, the long-term capital gain would be somewhere around 74.33 would be my long-term capital gain. So what are the special provision under section 47? The provision says if your transfer is exempted under section 47, then in that year, we will not calculate anything, but in the year in which your asset is going to be transferred normally, whether sale extra, in that year, we are going to calculate the capital gain, for which the period of holding would be taken from previous owner, that is Mr. A. The cost of acquisition would be of previous owner. Accordingly, Mr. A cost of acquisition, but the index need to be taken as per the formula from the point of view of assessee, that is Mr. C in our case. So according to it, this would be your long-term capital gain. But a problem happens. Now, assessee object against it. Assessee says this is wrong. If you are taking the period of holding from the point of view of Mr. A, if you are taking the cost of acquisition from the point of view of previous owner, then why you are taking index from the point of view of assessee? This is unjustified. You should take it from the point of view of Mr. A, that means previous owner. Because you are assuming that there is no B exists, there is no C exists. Then if B and C does not exist for period of holding, for cost, then why assessee exist for the purpose of indexation? So that case has gone in CIT versus Manjula J. Shah. And government, the court accepted that yes, the index should also be taken from the point of view of previous owner, not from the point of view of assessee. So, for the purpose of Manjula J. Shah, we have to recalculate the capital gain. Only one thing needs to recalculate, and that is your cost of acquisition, because we need to change the index only. Everything else would be remain the same. So this is as per the act. The solution, this solution as per the act provision. And now this solution as per Manjula J. Shah. There is only one change. The sale consideration would remain the same. The period of holding, etc. Everything would remain the same. Assessee would be the C only. So no change till over here. The only change would be in index cost of acquisition index value. So now cost would be 12,363. Now we will take the index from the point of view of previous owner. Now previous owner is Mr. A, who purchased that asset in 1990. So either 1990 index or 2001, whichever is later. So later would be 100. So index now from the point of view of Mr. A, that will come 100. And due to this, my cost now, index cost would be 43.56. The index cost of improvement would remain the same because that does not affect with the index of assessee or previous owner. So now you can see after this, my capital gain would be reduced, and now it would come around 45.24 lakh, which was earlier 74. It has been reduced to 45.24 long-term capital gain. So according to Manjula J. Shah, you have to take period of holding, cost of acquisition, and even index from the point of view of previous owner. And according to Act, you have to take index of assessee, but everything else from the point of view of previous. Now the question should arise in your mind, what we need to do in examination. But the problem is this, even after the judgment of Manjula J. Shah, which accept that the index should be used of previous owner A, Act did not rectify the formula. Act still the same formula is there which says transfer year index above, and for the purpose of dividation we have to take the index of assessee. So the act does not amend it yet, even after the judgment which has been done by Manjula J. Shah. So now what will happen in examination? It's a very sad news to all of you. You have to solve it via both manner. Once you have to solve it as per act, taking the index of assessee, and then you have to solve as per Manjula J. Shah, taking the index of previous owner. If the question specifically says that you have to solve as per act, then you need to only solve as per act. If the question says you have to solve only as per Manjula J. Shah, then you can solve it as per previous owner. But in my opinion, in the question, it would be only written that you have to solve the capital gain, most beneficial to the assessor, or even not written most beneficial. Even if they say you have to calculate the capital gain, you have to solve it by both cases. And if you are thinking that, oh my God, this would be a very huge calculation, no, students, no. You just need to change one thing. That's it. Everything else would be copy paste. Nothing. None. Consideration, sale consideration, index cost of improvement. Everything would be same. You just need to change one index. And your answer would be exactly the same, all other things. Just like this. So now you understood what is Manjula J. Shah. In Manjula J. Shah, you have to take everything according to previous owner. And in normal case, you have to take everything according to previous owner except the index. Okay, somebody wants to, Nidhi wants to ask something. So just a second, Nidhi. Nidhi is asking 301 kaise aaya? It's an index that would be given in question, the index of the year in which assessee held that asset first time. Okay. Priyanshi is asking why taken COI done by B, because the provision says the cost of improvement need to be indexed, whether it's done by the previous owner or by anyone else. So because you did not reduce that cost of improvement done by Mr. B. So when we transfer that asset, we have to reduce the cost of improvement done upon that asset if it is done by Mr. B or A or anyone else, if it is after 1st 4/2001. दोनों मेथड में आंसर सेम नहीं आएगा. यस, आंसर सेम नहीं आएगा. निधि wants to ask something. Can we unmute Nidhi? She wants to ask something.
Sorry to disturb you, sir.
Yes.
Sir, please host Ashok ji, because he has left from the session.
Okay. Nidhi, you can.
हेलो, गुड इवनिंग सर. सर मेरा क्वेश्चन ये है कि जो मंजुला शाह वाला है उसमें बाकी चीजें सेम है, फिर यहाँ पे इंडेक्स कॉस्ट ऑफ एक्विजिशन जो है उसके अकॉर्डिंग बस यहाँ पे इंडेक्स नंबर चेंज हुआ है. तो मतलब हम दोनों मेथड से किसी एक ही मेथड को करना पड़ेगा क्या दोनों करना पड़ेगा? और लेटर वाले में जो है मतलब क्या पता करेंगे कि इंडेक्स नंबर हम वो चूज करेंगे? सर थोड़ा एक बार क्लियर कर दीजिए.
निधि, अभी तो पता है, अगर एग्जाम में क्वेश्चन में लिख कर देता है क्वेश्चन कि सिर्फ एक्ट के अगर कहता है मंजुला जे शाह के अकॉर्डिंग सॉल्व करो तो मंजुला जे शाह वाले से सॉल्व कर दीजिएगा. बट अगर क्वेश्चन साइलेंट है, वो कहता है सिर्फ कैपिटल गेन कैलकुलेट करो, तरीके से सॉल्व करना पड़ेगा और आपको नॉर्मल से भी करना पड़ेगा. दोनों में सिर्फ इंडेक्स चेंज होगा. इंडेक्स की सारी इंफॉर्मेशन वैल्यूज क्वेश्चन में गिवन होगी, और आपको सिर्फ इंडेक्स चेंज करके अपना आंसर दोनों तरीके से निकाल कर आना पड़ेगा, तभी मार्क्स मिलेंगे.
ओके सर.
ओके मिस.
सर एक चीज और है कि मतलब जो ये है मंजुला शाह वाले में मतलब ईयर क्या लेटर देखना होता है कि अर्लियर?
मंजुला जी शाह में आपको प्रीवियस ओनर के हिसाब से लेना पड़ेगा. अब हमारे क्वेश्चन में प्रीवियस ओनर जो ए था,
जी सर,
प्रॉपर्टी खरीदी थी 2001, तो हमने हायर वाला ले लिया, जैसे नॉर्मल केस में लेते हैं। अगर मान लो ए ने प्रॉपर्टी 2004 में खरीदी होती, तो फिर हम 2004 की जो परचेज प्राइस है वो ले लेते, एफएमवी को इग्नोर कर देते, तो वो तो नॉर्मल तरीके से कॉस्ट निकलेगी, उससे कोई फर्क नहीं पड़ता कि केस कौन सा है।
अच्छा, ओके सर, थैंक यू सर.
Students, in this actually, sir has said both the views, but in the examination, because it's not possible to write both the alternative and both the views and calculate as per both, so you can write any one of the view, but mainly because if you see, this Manjula Jesha court ruling is the very old ruling, and after that, it has not been challenged to Supreme Court, or there was no amendment in the act also after that. So on that basis, your main view should be as per Manjula Jesha, and as per the plain reading also you can answer the question, but the main view should be taken as per the Manjula Jesha only. So if you write in the examination, if a question comes on there, so you can solve your question only by Manjula Jesha, and you don't need to do solve the answer as per the plain reading of the act.
Okay, students, clear?
Yes.
To ask something, Varsha, what you want to ask, please go ahead.
Good evening, sir. Good evening, sir. Sir, would you please provide WhatsApp link of inter-group WhatsApp link? So there is group which is informed.
Technical team will provide you the
One second, I'm providing, sir. I'm providing.
Fine. So moving ahead. And everything has been written in this provision regarding this concept in our notes also. You can see that. Let me show you the provision. When the Manjula Shesha is applicable, what we need to do. When there's normal case, what we need to do. So you can see now the clarification part. In all above cases, capital gain will be exempted as transaction will not be regarded as transfer. But in above cases, when assessee will transfer these assets in normal case, in that year capital gain will be liable to charge as follows. For example, previous owner, Mr. A, purchased in 2012 a property, suppose for 10 lakh rupees. He gifted it to Mr. B, that is the current owner of that property. B sold it to C in January. Let's correct it, make it June 2024, not January, it's 2024 June. So he transferred it for 32 lakh to the buyer, Mr. C. So in this case, Mr. B is our assessee because he transferred this property to Mr. C. And Mr. A is the previous owner. So what will happen? Everything needs to be calculated according to Mr. A. So you can see the clarification. For Mr. B, capital gain, period of holding will include period of holding from previous owner, 2012 till 2024. And cost of acquisition also as per previous owner, that is 10 lakh rupees. Index for normal case of Mr. B, assessee need to be taken. In case of Manjula Jesha, we need to take the index from the point of view of Mr. A. Again, the clarification says, what is the difference? In case of all above transaction, the cost of acquisition would be taken from old cost of acquisition. That means from the point of view of previous owner. The period of holding also from the point of view of previous owner. And as per Act, the index would be as per the new owner. But in case of Manjula Jesha, it's very simple. You need to take the cost from the previous owner point of view, even the period of holding and the index also from the point of view of Manjula Jesha. Now the 13th point. This is for reverse mortgage. Now what is the meaning of mortgage? Mortgage means when we take loan and against that loan, we mortgage our property. It a normal mortgage means if we have taking a loan and against that loan for the purpose of security, we have mortgage our any property. In case of normal loan, generally how it happens, suppose there is a building and Mr. A wants to mortgage this building. Suppose the value is 20 lakh rupees. And Mr. A decided to mortgage this building to a bank And against that building, he needs to take loan. The bank says that we will provide you 60% of the value of this building as a loan. So bank mortgage this property and provide Mr. A 12 lakh rupees loan. Clear? And Mr. A needs to repay this loan by way of EMIs. That depends what kind of time duration we need to repay it. So EMI will be according to that. So in the normal case, whatever you receive in lump sum as a loan, that cannot be treated as income, because income means something which you need not to return. And if something is your liability, that cannot be treated as your income. That's a normal mortgage scheme. But we are not discussing the normal mortgage scheme. We are now into the new mortgage scheme that's called reverse mortgage scheme. This mortgage scheme is only for the senior citizen. The special character of this scheme is for senior citizen. Because as the name suggests, it is reverse mortgage scheme. So a normal mortgage, you receive the loan in lump sum and you have to repay it in EMIs. Now we are going to reverse this concept. So the first special condition, this is going to be available only to the senior citizen. The second interesting thing is this. In this scheme, in reverse mortgage scheme, this is for senior citizen. Suppose there is a house. There is Mr. A and Mrs. A. They are having some financial crisis, suppose, and they need regular payment for the survival. So if they will go for a normal mortgage scheme, they will get the amount in lump sum and they have to worry about the repayment also. They need to repay it, and if they are not able to repay it, the property is going to be confiscated by the bank. So to remove this difficulty, a new scheme that is only applicable for senior citizen, that is called reverse mortgage scheme, has been introduced. Under this scheme, a variety of new transaction kind of loan has been introduced. Now suppose Mr. and Mrs. A, because they are senior citizens, so they need some regular payment for their survival. Suppose they are having this building of 20 lakh rupees. They went to the bank for reverse mortgage scheme. Bank valued it and provide 60% loan, that is 12 lakh rupees. Now till here, this is same like mortgage, but now the change occurs. Now if the eligibility is 20 lakh rupees loan, the bank decided that we will provide you this loan in EMI form. So now you are not going to get 12 lakh rupees in lump sum. You are going to get this loan in EMI. Suppose 10,000 rupees per month. So bank will provide 10,000, 20,000, whatever it is. We are taking 10,000 rupees per month will be received by Mr. A and Mrs. A as EMI of loan. So that means, and they no need to repay it. So you might be thinking, if we do not need to repay it, that could be my income. No, it is not the case. You do not need to repay it till you alive. After the death of Mr. A and Mrs. A both, the bank will recover their loan and interest from transfer of this property. So you will get 10,000 rupees per month and you do not have any worry to repay this loan, because the repayment would be done by bank by transfer it only after the death of Mr. A and Mrs. A. So there could be situation, there could be a possibility also. Suppose Mr. A and Mrs. A arrange money from somewhere, they can repay the loan with interest and they can freehold their property also. on death of Mr. and Mrs. A, this could also possible some legal heir of Mr. and Mrs. A can come, they can prove, and he or she can repay the loan with interest, and they can also take the property, etc. But bank is not going to ask for any repayment till Mr. A and Mrs. A alive. But there could be a problem that in a 1 year, they will receive 1,20,000, 10,000 per month. So in a year, they will receive 1,20,000 out of this 12 lakh rupees loan eligibility. And within 10 years, 12 lakh rupees payment would be received by the Mr. A and Mrs. A. Then suppose if after 10 years they survive, they did not passed away, then they need more money for future, but all 12 lakh rupees loan has been consumed by them. So what will happen? This scheme beauty is this: after 10 years, this property value must have going to increase. Suppose it's increased by 10 lakh rupees. So again, against this 10 lakh, again bank can allow fresh loan of 6 lakh rupees, which can be again transferred via EMI. So this EMI kind of survival needs, which was for Mr. A and Mrs. A, they could receive this amount of money regularly, and they need not to bother about to the repayment, because the repayment would be start only after the death of Mr. A and Mrs. A. So what this kind of scheme is doing under capital gain? Why we are discussing this scheme in capital gain? This should be the part of some banking chapter, etc. Because there is a question arise that is this EMI which is receiving by Mr. A and Mrs. A, it could be considered as their income or not, because they do not need to repay it. So whether it's their income or not, could it be treated as their income or not? And when they mortgage this property, which would be auctioned by the bank or transferred by the bank after their death, is it a transfer? So can it be chargeable to tax under the head capital gain or not? So there are two questions arise. First one, when you mortgage your property in case of reverse mortgage, whether it could be regarded as transfer and capital gain provision applicable. And the second question, whatever you are receiving as a regular payment of EMI, which you need not to repay till you are alive, whether this should be treated as your income. So this question arises. That's why we are reading the provisions of reverse mortgage scheme. Okay, just a second, Mr. Ashokji, just a second. Okay. Done, Ashokji. Okay. So both question answer is that, and it says because it's still a loan process. When you mortgage your property, that would be the part of your loan process. So it cannot be regarded as transfer. So there would not be any capital gain provision on reverse mortgage scheme at the time you mortgage your property to the bank. And whatever you are receiving as 12,000 rupees or whatever amount it is, which you need not to bother to repay, it would not regarded your income also, because it's a liability. Whether you are receiving it lump sum or whether you're receiving monthly, it's still liability, because that need to be paid from your property. Whether you are not repaying it does not matter, but you have your property needs to repay it. So the answer, capital gain provision would not be applicable, because this is not regarded as transfer. And the second, it will not also be regarded as your income, because it's still a loan, whether receiving lump sum or in part. So that would be the case of reverse mortgage. Both question has been clarified in this case. Step one, you can go through with the provision. It's a very simple process, but the question which arise regarding the income taxability or the mortgage would be regarded as transfer, that has been clarified. You can go through with the provision, very simple provision. Here are some example also. That is also for your homework. Please do it. We will discuss these example and the question I have suggested to you. We will discuss these question and this in our next class. These notes has been already uploaded. This is example of reverse mortgage. These are also example for your homework. We will discuss all these in our next class. This is the definition of amalgamation. If you want to understand what is the meaning of amalgamation, you can go through with this definition. If there's any issue, I will solve it. And the definition of demerger is also there. You can go through with the definition of amalgamation and demerger yourself. So we have discussed 12 points in which if there is transfer, how we need to deal it when the property is going to be sold in future. 13 point we have discussed the reverse mortgage scheme. We have left with point number 14, 15 also. These are also the case of transfer in which there is exemption. Then why we did not discuss these point number 14 and 15 before? Because the treatment of these 14 and 15 point is different. Manjula Jesha does not applicable in case of 14 and 15 exempted capital gain. It is applicable from point number 1 till point number 12. 13 is a separate provision. There is no concept of transfer is there. So there is no exemption requirement. But 14, 15 also exempted capital gain. But what kind of these exempted capital gain? How we need to calculate capital gain in this situation? These are different from the above provisions. So that's why we will discuss point 15 and 14. How we calculate the capital gain in this point 14 and 15 cases. That would be the part of our next session. Mr. Shan is asking, sir, both need to die for house being taken by the bank? Yes, it is specifically written that even if one is survivor, the loan could not be repaid till the death of both Mr. A and Mrs. M. That's why it's a very interesting technically scheme for the help of senior citizen. Those are having survival issue because if they do not have regular income, so there could be a problem in that case. Okay. If anyone wants to ask, please go ahead.
Thank you, sir, for this wonderful session.
Excuse me, ma'am. Excuse me. Excuse me, sir.
Yes.
Ma'am, sorry to interrupt. Ma'am, I was not able to access the WhatsApp link. So would you please send it again?
Oh, pardon me?
Ma'am, I was not able to access the WhatsApp link. Would you please send it again?
Yeah, sure. I will send again in the chat box.
Thank you very much. Thank you very much.
Okay. So, student, this what was I telling about this? Your head of income capital gain. This is the one of the more important head of capital gain. You need to pay your due attention for this capital gain because by Finance Number 2 Act 2024, there's a lots of amendment in this capital gain because of now indexation. Your indexation has been done away. Then your period of holding has been changed. Then your tax rates has been changed. Then in section 112A, that earlier exemption was 1 lakh. Now it has been increased to 1,25,000. And there is other buyback for equity share. There are other so many amendments in this chapter, and specifically the dates. You have to be very, very, very careful regarding the dates while solving the question related to capital gain. Because date is very much important. If you see for period of holdings or for tax rates, for your indexation, the date 23rd July 2024 is very important because you have to see whether transfer is before 23rd July or 23rd after or on or after 23rd July. Because just for this simple date calculation, your whole calculation, your whole computation, your everything will go under a change. So it is very much important to understand the provision and to understand the implications also, just because of changing the dates. So when you solve the question in the examination, please pay attention to the dates when the asset is transferred. If like sir has told regarding the indexation also, then the forthcoming for long-term capital gain on your land and building. in that case, there is a separate benefit also is given to the resident individual and HUF when they can take the benefit of indexation with the 20% rate, and they have an option without indexation at 12.5% rate. All these provisions that sir will be dealing in the forthcoming classes. Sir has taught capital asset, period of holding, your that transaction which is not deemed as transfer, your indexation, your cost of acquisition, many provisions sir has been touched upon, and he has given certain homework also to you. So it is very important you just do your homework very sincerely. Whatever the question, whatever the doubt that is in your mind, just take the benefit of these classes and ask the questions from the sir and clear all your doubts, because sir is here. We BOS faculties are there to solve your all doubts so that you can just shine in your examination. You don't, there is no provision or no confusion left in your mind while solving the paper in your examination. And with that, student, the feedback. After each and every class, please give your feedback so that if any shortcoming is there or any suggestion which you can give to us to make this LBC more useful to you, then we are most welcome. You are most welcome. We are very much into it to help you to throughout your study and to guide you for your this journey to CA examination. So if you have any query, sir is there. You just ask me a query. I am also there. If you have any query, I received from Pooja, there is no query, sir. Hand over to you, sir, if you have any query in your chat box.
No query yet. No query, ma'am, from here in chat box. Student, please also revise this provision. In the next session, again, we will have a recap of summary of provision, what we have discussed today. So I'll ask someone to summarize those provision. As you, today Priyanshi has summarized beautifully. So please, all of the students also try to summarize the provision. In the next class, somebody has to come and give us a short summary of the provision, what we have discussed in today's class. So I guess there is no more query, sir. So can we close the session, ma'am?
Yeah, sure, sir. Thank you, sir, for the session, for the wonderful session, sir.
Thank you. Thank you. Yes.